Hi everyone, I'm Teresa Marzoff with Culture Engineered, and I'm here today to talk to you about benefits. It's November, and most employers' benefit plans will end December 31st, and new benefit plans will begin January 1st. So we get a lot of questions about this process at this time. So I'll be here every week providing you some quick tips on how to better manage different aspects of that process and answering questions that we get quite frequently. So today we're focusing on what to expect from costs for benefits. In 2018, the average premium for insurance was $574.67. This is up 3% from 2017, and it's projected to be up another 5% in 2019. For family coverage, 2018's average was $1,634.67 per month for family coverage. And this was up 5% from 2017 and is also projected to go up another 5% for 2019. So there's really four things that it comes down to that will make or break your premiums, I guess. The first one is the company size. So there's two classifications: if it's a small company or large company. Small companies are under 50 employees, whereas large companies are 50 plus. And for small plans, your rates are calculated based on age-banded rates. So let's say you have employees ranging from ages 18 to 45 years old. Each of those groups within that, based on their rate, will get a different rate, or based on their age, will get a different rate assigned. So for ages 19 to 25, for example, will be one rate, 26 to 30, and so on. Generally, the higher the age band, the more expensive the premium. Whereas larger employers, they have what's called composite rates. That's an average of the demographics, and their rates fluctuate based on claims history. So how my company and I use our benefit this year will dictate our premiums quoted by the insurance plans next year. So it looks at really how much insurance we're using. For the type of, another thing that can really impact the premiums that you receive is the structure of your plan. So that can be if it's an HMO, a PPO, a high deductible plan, or a point of service plan. Keep in mind the high deductible plan, that's a high deductible of, there's minimums on those types of plans because typically they accompany some sort of HSA or FSA, and those plans have a minimum of $1,350 for single coverage, and that would be a minimum deductible, or a minimum deductible of $2,700 for family coverage. And then the third thing that can impact your rates, your premium rates, is the coverage. So the coverage itself. So how high or low your deductible is, co-insurance, what percentage co-insurance the insurance is paying after you meet your deductible, and your max out-of-pocket, and whether or not you have co-pays to your plan, going for primary care, specialist, urgent care, emergency room. Co-pays play a big part in that. And then finally, your broker commission. So brokers are paid through a commission built into your monthly premium. So that can either be a flat fee or a percentage, and it can vary a lot by size of plan and state. So broker commissions can be as low as just over $1 per month per member, to as high as just shy of $50 per month per member. It's a really big range. So how to keep your costs down comes down to a few things. Smaller employers or plans, because they are based on age alone, really the creativity will be about your structure of your plan. So how high or low your deductibles are, co-pays, all that good stuff, and then also whether it's an HMO, PPO, and so on. Larger companies will instead want to focus on the use of the plan. So our employees not, participating in preventative care aspects of the plan, and instead going to the hospital only when things have escalated so much. So another option is to have a self-funded plan. Self-funded plan have very low premiums because in addition to paying premiums, the employer is paying when employees use their plan. So when they get prescriptions, when they get go to the doctor, the hospital, not only are you paying those premiums associated with monthly coverages, you're also paying for their use. So historically, this has been losing popularity with many employers, and has been something mostly used by larger employers because they can kind of sprinkle out that risk. You can, however, get self-funded plans with a stop loss. So basically, if something was to happen, a really big, claim was to come through, it stops at the point you're paying for the claim and the insurance picks that up. So that is an option to kind of minimize that risk with self-funded plans. Also, I recommend shopping a variety of carriers. Sometimes brokers are tied to certain carriers and sometimes employers are. Carriers a lot of times will focus on certain types of companies, whether it's size, industry, what have you, and will make very creative, even financially, incentivize employers to come and use their insurance. And then lastly, move away from the calendar year benefit plan. So if maybe you have a March 1st start date to your plan and it ends in February, so you're not on a calendar year. There are some arguments that say that in itself will save you some money. While that's debatable, from what I've seen, I definitely know it will save you on service because carriers and brokers are so busy this time of year getting rates out and administering open enrollment. Particularly small employers get a lot more love and service when they're not going with the plan year simply because they're more available. So hopefully these are some good tips for you. Next week we'll be talking about how to determine the share of cost of benefits. So how much employers should pay, how much employees should pay, and check in for that update. If you need additional help or have more questions, please let us know at Culture Engineered. Otherwise, we're happy to help you with any individual needs that you might have. You'll also find some resources here in the comments section of this video, and hopefully that gives you a good start.